Now, let me ask you this. You know that there are uh, interest rates have been dismal. I mean, they've been negligible. And now that we're moving in an inflationary environment, obviously the demand for money to the banks, for example, they don't borrow as cheaply as they did from the Federal Reserve. They have to pay a rate. And consequently, that's going to put a burden on the government itself because they have borrowed so much money because the interest rates were zero.
Yeah.
And now the payback is up much higher. I think interest on homes went up to over 7% this last week. So it's going to affect the housing market, that's for sure. Now you need a little more cash. You're going to buy a house or something, you need some. You want to get the most return on that cash. I know we're talking about investing in something for more growth, but we may be looking at an opportunity where you're going to need some cash in reserve. You should have some anyway. You don't. So with the banks paying practically nothing, what are some of the alternatives to getting a little bit more return on the cash while you're holding?
Well, one of the difficult ones to get that we've discussed this is I'm a big fan of the Series I bonds right now. Those are paying very well. They fluctuate. They're backed by the full faith and credit of the United States government. That doesn't have as powerful of a statement as it used to, but they're going to back them and make sure that they don't default on them. And those are something that good. They're limited to 10,000 per person, so it's not a large amount, but it does allow somebody up to 10. You don't have to do 10,000, but up to 10,000. But those are good. You've got to go online to the IRS to get them. They're very difficult, as you know, time-consuming, but those are a good place for a couple. And so if you say there's two people that maybe you've got $40,000 in cash. Well, you and your spouse could do one. That's $20,000 this year if you can get it in. I think October. The date is probably here now. I think.
Yeah, I think it's the end of this month.
Come. Yeah. But you can get those by the end of the year, and then next year you get another $10,000. Then that's $40,000, and they're currently paying a 9.62% interest, which is very, very good in this market. So those are good. I'm always a fan of real estate. I don't. You can do it through the market, which is a REIT, but that's market driven, so it's a little different. There's nothing wrong with that. But if you can buy and hold real estate, I think that's good because it's very difficult to find things that are safe that are giving us a good return.
Absolutely. And there are many ways to invest in real estate. As you were saying, you can get into a fund, which is good, and there's some funds that are developed where it's a little shorter term and some much longer term. But there's some funds, for example, that have bridge loans where you can invest even with fund companies that when a developer is starting a project until he has to have that funds to hold it till it gets a mortgage on it. And then, so there are many, many, many ways. And sometimes I've thought about this. Some people they get their basic, they invest well, they're disciplined, but they get a little itchy to try something. We used to say the top 5% of your assets is good to play with, not be careless, but to try different things like maybe a stock or something in real estate that you haven't done to begin to balance out your portfolio, but also to taste. Get an experience. You don't know something until you get into it.
That's very true. And as I tell people, right now is a good stock buying time. I would say that about any time. And I had a conversation this last week with an individual. Said, "Well, I'm going to wait for it to go down a little bit more." And what do you think about that? I said, "Well, that's a terrible plan. You're timing the market, and nobody to date has been able to do that. And I can pretty much guarantee you, nobody in the future will be able to do that. It's just we can't predict all the things that go with that. So now's a good time. And so people ask me, well, how do I do that? Well, the best money managers in the world, the people who do that for a living, who are institutional managers, use a principle we call nibbling, which is buying a little bit at a time as it's moving. So you might be buying it on the way down and then maybe on the way up, but you're nibbling. You're not trying to time the market. And so if you have a little cash to deploy, You'll hear me say this over and over. I like indexes. That's a big, broad-based buying all the stocks. But whether you do a little research and find a company, do it through nibbling. Deploy a little bit at a time. And now's a good time to do that if you have some cash, because if the company if the company financials are strong, then they're going to come back. They're not.
You make a good point. Most people don't look at the key to successful businesses happens to be the management of it.
That's right.
You can have many direct marketing companies start and explode, and then because the management cannot handle that kind of growth, they go out of business or don't continue. So looking at management, that's something that professionals look at. They look at the details that you and I don't want to take time. How many boxes are being made at the at the manufacturer because it takes more boxes if things are growing and more shipping? How much warehouse space is available and what is the vacancy of it? I mean, on and on and on, and all the little things. How much railroad traffic is there? How many box cars are moving? How many of them are empty? How many get into that kind of detail that tell them a lot more to anticipate the market than you and I have that ability. So we turn it to the professionals.
Yeah, absolutely. But if somebody has that cash, that's a good thing to deploy. Again, find somebody, let somebody guide you on that, and then just nibble in, and you'll be, even if the market starts going up, don't be afraid to buy back in that. One of the probably top 3 biggest mistakes I make is people trying to time the market. They pull out their money as it's going down, and then they throw it back in as it's going up. And as I've said many times, because it's a mirror, you're actually doing the opposite. When the market goes down, you're selling at loss, and when it's going up, you're buying at a high. So you're doing the opposite of what we've always known to do, right? Buy low, sell high. You're selling low and buying high, and that's not a good ingredient for building your portfolio.
Discipline.
Yeah.
All the way back to that word, the big D word we don't like.
We don't like it. Discipline. You can maintain that discipline and consistency. That'll go a long way for you.
Amen.
Absolutely. I hope you enjoyed the broadcast today. I hope there are some things that can really help you to get investing or keep investing. That is our desire here. I wanted to make quick mention of helpmeinvest.com. Helpmeinvest.com. An organization that we've put together. There's no fees. There's no products to sell you. It is literally designed to help you invest, to become a better investor. So you can go there, set up an appointment for 30 minutes. We'll spend some time with you. We'll go through your portfolio. We'll help you get started wherever you're at. Helpmeinvest.com. I hope you'll take advantage of it. I hope that you will continue to send in your questions. They mean a lot to us because we can talk about a lot of things, but what we really want to do is find out what's important to you, the level of understanding, the questions that you have, so hopefully that we can add value to your investment knowledge and that you can increase and grow in that and stay curious and read as much as you can, get as much information. But when you have a question, please feel free to just send that in to us. Send those questions in because we really do enjoy them, and answering them helps us to make sure that we're being relevant and pertinent to you.